Welcome to Wealth Building Starts Now, the show where we connect real strategies to your real life goals. I'm Eric Hersey, here with Steve Waters, CFA from Riverbridge Wealth Management. Today, we're talking directly to business owners, not just how to make money, but how to keep more of it, grow it, and eventually turn your business into something that can support your future. Hi, Steve. How are you doing today?
I'm great, Eric. Yeah, good to be here to talk about businesses and small business owners. 99% of all businesses in the United States are small businesses, and they account for over 40% of the U.S. economy. So this is it's a significant part of our country, and there's a lot of things that business owners can do today to help their businesses be more profitable and help their overall personal financial situation.
Yeah, right. And I mean, there's a lot of, like you said, there's a lot of small businesses out there. So this is a message for everybody. So when it comes down to small businesses, what do you think, like one of the major mistakes or things that they need to know? Like, what is an advice you would say from a small business and financial standpoint, things that they're not doing or should know? Because sometimes when you're a small business, you go from a technician to an actual business owner you don't know, and you don't have the people kind of in your corner saying, hey, you need to do this, you need to do this, you need to do this. So good opportunity for us to talk right now. So what is some of those items? What's top?
Yeah, I wanted to talk about some tax tips for business owners. There's a lot of things that business owners are either unaware of or that they're not actively pursuing or using. And these can be big cost savings for them in their business. So I have 5 of them that I wanted to walk through today.
Love a listicle.
Yeah.
All right. So first things first, and I know this firsthand because when we first met, I'm just an LLC, kind of run my thing. And the first question you asked me was about an S-Corp, right? And I had no idea what you're talking about. So for those out there that don't have an idea what that is, I think that's your first tip. Explain to us what an S-Corp is and why that matters.
Yeah, so there's different ways to structure your business, right? You can be a sole proprietorship, you can be an LLC, you can be designated as an S corporation, or the big companies are designated as a C corporation. Generally, the smaller businesses, they won't be a C corporation. That's more so for like publicly traded entities, that sort of thing. But so a big difference between a sole proprietorship and an S corp is if you're a sole proprietor, you only compensate yourself through W-2, like payroll wages, right? Whereas if you have an S corp, you pay yourself a salary, but then whatever's kind of left over as the profit from the business, you can take that as a draw. There are some pretty significant tax advantages if taking money on a draw versus just paying yourself via W-2 wages. So we can look at this chart. I think it does a good job illustrating how this would work and some of the tax savings that are available. So in the first column here, we have that if you're a sole proprietor, right? And let's assume that in both scenarios, the business owner is making $100,000 a year. Well, if you're a sole proprietor, you're only paying yourself through W-2 wages. So you have to pay payroll tax twice, right? So you have to pay it as the employee, but then you also have to pay it as the employer. So there's Social Security, and then there's these Medicare taxes at 1.45%. So you get hit twice for both of those. So in this example, $100,000, that business owner is paying $15,300 in total tax for payroll,
which is what you would expect if you were just a W-2 employee for anybody. Mm-hmm. But you're a business owner and you're taking a lot of risk and you're doing all types of stuff. There's benefits to this next one. So when you become an S corp, what happens?
When you become an S corp, you're able to take a lower salary, right? And taking that lower salary, you essentially pay half as much,
right,
in taxes because you don't have to pay the payroll taxes on the business draw. Okay. So in this example, right, it's you only paying yourself $50,000 in W-2 wages. Obviously, that's half as much. You owe half as much as tax. 0 on the draw. So you cut your tax bill in half just by structuring your business this way.
Right. And this was the major questions that I had. Number one is that this is how it's not necessarily from protection, right? You're still being protected. When you're an LLC, you're like, you don't want to get sued. You lose yourself. Your business can get sued. You can lose that. But this is just from how you're tax classified, right?
Exactly right. Yeah. Yeah. And so like with an S corp, let's say if there's more than one owner, each owner, ultimately it flows through to the owner's individual tax returns, their individual social security numbers. So there's no tax paid at the company level. It all flows through the individual. This is just a great way to save some money. But there are some risks that we should point out here. So number one, the IRS, they're hip to this jive, right?
Yeah,
They
yeah.
know why people
Right,
would structure it this way.
Right.
So if you're in an industry where the typical business owner would be making $100,000 a year, and you only pay yourself $20,000 a year in the W-2 wage, that's going to be a red flag.
Right.
Okay. So you have to pay yourself something that's commensurate with the industry average.
Right.
Okay. And then the rest can be taken via a draw. But so what this does is it increases the risk of audit. Okay?
Sure.
So you just need to make sure that all your T's are crossed, I's are dotted, for how much you're paying yourself and how much you're taking on a draw.
Right. So when it comes down to it, be very look at your industry averages, say, hey, this is how much somebody in my industry would do. If I would go get a job doing this for somebody else, is that a good, fair assessment to say, hey, if I had to go get a job, this is what they would pay me my salary?
Yes.
And then you basically reap the benefits of your business being better, good, in a place like that. But I think that was a key eye-opening experience for me and for a lot of people out there, because like, who wants to pay the more taxes? I mean, at the end of the day, doing the same work, you make the same amount of money, but it's just that one small thing that someone like Steve says, hey, are you doing this? Mm-hmm. Oh, look at that. That's an extra vacation, or that's just, paying your house off early, all types of savings there. So there was another thing that I think you mentioned to me once, and I didn't quite understand it, but you're going to explain it more and out there to all of us. And that's about your kids. Mm-hmm. Explain this to me, putting kids on payroll.
Yeah. So a lot of business owners that have children, they end up working in the business, anyways. They'll bring them in to pull them in for,
right.
whatever, sweeping the floor, even depending on how you're doing clerical work, that sort of thing. If they're under the age of 18, the IRS allows for you to pay those children with zero federal income tax. Okay, so this year you can pay any child up to the age of 18 $16,100, zero federal income tax. Now there is still state income tax mm-hmm. that would be owed on that, and there's some ways around that. Like the child can then use that money to fund a 529. One of the biggest benefits, I think, to that is the child now has earned income.
Right.
And what that allows them to do is contribute to something like a Roth IRA. Think about a kid, and we talked about the power of Roths, in the podcast before. But think about a 12-year-old kid that's able to get a few grand into a Roth IRA. What's that going to grow and compound to 60 years from now? It's significant.
Right.
So these are great ways to say, because you're going to be paying the kid anyway, right? So you might as well take advantage of this. But then they can also take that money and then invest it.
Right. So, I mean, I guess the hardest situation here is, all right, I have a 6-month-old. Is that going to be a red flag?
Yes. Yeah.
So what would you suggest in terms of like, all right, there's a certain age, certain businesses, what kind of things would you have them do? And like, how do you track this? Like, I mean, do we have to have paperwork? Do we have to have like an application? Do we have to have a job description? What are these types of things that say, because I can have my kid go in there. I'm like, hey, can you go sort this paperwork? Can you file these receipts? Can you scan stuff for me? And that's applicable. And I would have to do it, or I'd have to pay somebody else to do it. Having your child do that and teach them that. But like, how do you have to be able to prove that to the government or anything in case you get audited?
Yep. It has to be legit. So it all has to be documented. Okay. You can't say that your 7-year-old is the CFO of the company or anything like that.
Sure.
But I mean, these are things that happen all the time, right? I mean, and it's natural. You have a child that wants to work. You have work that, clerical work, whatever, sweeping floors, mm-hmm. cleaning. That's all legitimate. Just document it. They come in. You could pay them zero federal income tax.
And that sounds like a good deal. And I mean, for the most part, like you said, 529s. I mean, if you have a private school where they're doing things like that, or if you essentially were getting them allowance or whatever in many aspects to go do these things, that's now their money that they can do. And that essentially is not coming out of your bank.
Exactly.
Your account. That sounds like a good one. So who do you talk to get that kind of set up? Is that you've got to get them on your payroll? You have to talk to everybody to kind of treat them like a real employee in a sense, like all the paperwork that you have to file?
Yep, it would be through payroll, and then also talking through this with the accountant so that they're aware as well.
Awesome. All right. Well, the other one here, I'm a little less know about it, and it sounds pretty technical. It's Section 179 deduction. Steve, you're gonna have to take this one because I don't know much about it.
Yeah. So this is purchasing. This would be for any really capital expenditure.
Okay.
But a lot of application here for small business owners is vehicles. So if you have a car that's over 6,000 pounds that you use primarily for business use, you can purchase the car in the name of the business and get a tax deduction. So the example would be, let's say you buy a car that's over 6,000 pounds that you use primarily for business, and let's say it's 50 grand.
Okay.
Right. And let's say that you use that car 90% of the time for business use.
Right.
So 50,000 times 0.9, that means that you can deduct 45,000 from your taxes in that year off of your income.
Okay.
So let's say you're on the top tax bracket, which many business owners are, 37% tax bracket. That's a federal tax savings of over $16,000.
Yeah. Yeah. So what would you classify as like business use? I mean, at the end of the day, I'm sure it's one of those things where it's like, all right, well, I'm still taking my kids to school and I'm still driving to the shopping, in this car. Is that allowed? Like what is classified? You say 90% of it has to be work related?
90% was just an example.
Okay.
It has to be primarily used for business.
Okay.
But I mean, anytime you're going to meet with customers, or you're
Right.
going to sales or team meetings, anything like that all counts as business use, and it can be used. Now, what goes away with this, Eric, is if you don't do this, you have the ability to deduct mileage, right, from your business. A lot of people do that. That goes away with this. You can't deduct your mileage each year. You just need to keep a log in case the IRS comes knocking, just to show that, yes, I do use this vehicle primarily for
Okay. So it's just you almost do an assessment of like, hey, what do I think I'm getting more for, or what makes the most sense for this business? But primarily, if you are using a vehicle and you're traveling a lot or anything like that, this makes a lot of sense if you buy that vehicle.
Yep.
So, once every 7 years or however long you keep your vehicle, it sounds like a pretty significant tax saving there.
Yep.
All right, what is the Augusta Rule?
Yeah, so this one's interesting.
I've heard of this, and I'm like, I don't know how you pull this off or how this works, but how's it work in West Virginia? If you're a Gulf side like residency, it's a little different, right?
Right. So it's called the Augusta Rule because of the Masters, because of the
Right.
golf tournament every year that takes place in Augusta, Georgia. And so the residents around the course, there's big money that's to be made there from renting out their houses to patrons that are coming to see the event. So they were able to convince the U.S. government that they should get a tax break on renting out their house. So it doesn't just apply to them; it applies to anybody in the United States. And so you can rent out your house to a business for up to 14 days without having to pay any federal income tax on the proceeds. All right, so let's walk through the example. So let's say the going rate to rent a house in your neighborhood is $500 a day. So multiply that by 14 days. Let's say you rent it out for 14 days. So that's $7,000 that you don't have to pay any income tax on,
right,
for the business. It comes free of federal income tax.
Okay.
So this is Apple. A lot of business owners, they'll have vacation homes or lake houses, that sort of thing. So you can use this if you want to have like say an offsite team meeting.
Right.
Or something like that.
Okay.
Again, this has to be documented. I would say this is a little bit more of an aggressive accounting tactic.
Sure.
But this is something that's totally legitimate as long as it's documented and legit.
Okay. So, I mean, in our area, it's Festival Lights time. You get somebody who wants to, you're near Ogilvy and you're like, hey, you don't want to have to travel too far. So you essentially could be like, hey, we're going to go out of town on vacation. We're going to rent this out. And that's an income stream that you can have plus deductible from taxes.
Exactly right.
Okay. So, I mean, I'm sure there are some people that can definitely utilize that. All those people on the golf courses certainly can. All right. So last one, just talking a little bit about company retirement plans.
Yeah. So this is, the 401k plan. It's a great way to save money on taxes, whether you do the pre-tax or the Roth. We talked about that before. But it's a lot of money that you can stash away in these tax advantaged retirement accounts. So 2026, you're under the age of 50, it's $24,500.
Okay.
That you can take from your income and put it in there. Over 50, it's $32,500. So it's significant. But it also, if you have money in a 401k versus an IRA,
right,
you have the ability to do a backdoor Roth IRA contribution. If you have a traditional IRA with a balance, it doesn't work as well.
Right.
It's this thing called the aggregation rule. So there's many tax advantages to having a 401k versus a simple IRA or a SEP IRA.
Now, when you're talking company, this is as a company, you can set this up for yourself or you set this up for all your employees, or like we're talking small companies. It was like we got 1 or 2 employees and stuff like that. Is it one of those things where you have to offer it to one, you have to offer to all?
Yes, it's called the discrimination rule. So you can't just set it up like for yourself. Now, if you're the only person that works in the business, you can do it's called a solo 401k. That's allowed. But yeah, there's rules. And if you put money in for yourself via the company contribution, you have to do the same for your employees. And there's different parties that have to get involved, third-party administrators, that sort of thing. But there are a lot. This is something that both Democrats and Republicans agree on, is that they want to encourage businesses to create these company retirement plans, and they have some really nice, tax credits and tax incentives available to do this.
So it might be one of those things where you're looking, oh man, I don't want to have to, I got 3 people on my team and I don't want to have to offer, retirement to everybody. But it might be an opportunity where like there's going to be enough savings that like, hey, for your own, because you're putting money away in your own savings, it might be good enough, better for you to open it up for everybody and you save even more. So it's just one of those things where you just have to talk to somebody and kind of do the numbers to see how it makes sense, right?
Absolutely, yeah. And I mean, there's many benefits for the business owner individually, but then also as the team. I mean, it's a great retention tool.
Right.
It's a great recruiting tool, and it's overall it's part of the total employee compensation. So it's a great story all around.
Yeah, and everybody kind of, we're all trying to get to the retirement at some point in time. We're all kind of looking at the end of the line, which kind of bridges us to the next statement and kind of topic that we're going to talk about. Which is, as a business, you have to have an exit strategy, right? And a lot of these small businesses, like we were talking earlier, it's just like, this is their baby. They created this bad boy and they built it up, and it might be hard to leave, or they don't think about it. And they might say, I'm never going to leave, and we're all going to have an exit strategy in some way, but you have some general advice, tips, or just things to think about right now for these business owners from an exit strategy. So I'm going to open the floor to you to kind of just talk a little bit about like, what's that look like for someone?
Yeah, you're exactly right. I mean, a business is something that's very personal to that owner. And in many cases, they built it from the ground up, and that really is their identity. And so that the thought of even having the conversation about them leaving or not, not being involved, that's just, it's not something that they're willing to think about. But the reality is, Mother Nature takes over at some point, right? At some point, and so you need to make sure that you have all your ducks in a row. A lot of business owners, it's like 80% of their net worth can be tied up in one company. And so how do they make sure that passes on to their heirs and doesn't just, die whenever they're no longer able to be in the business? There's situations where this planning doesn't take place, and all of a sudden, the business owner's spouse, something happens to the business owner. Now their spouse owns their portion of the business. They've never worked in the business, they don't know anything about it. That's not good for the business.
Right.
That's not good for the customers. So there needs to be planning in place. There's these things called buy-sell insurance agreements, where it's actually the like if someone has a partner in the business, something happens to the other person, the partner gets the life insurance proceeds, and then that money is used to pay the business owner that passed away, their spouse or their children, to take ownership. So these are important conversations to have. It's all about protecting, a lot of business owners, you ask them, how much do you spend a month? They really have no idea. They don't know how much money they're taking out of the business. So it's
why are you calling me out, Steve?
Yeah.
No.
What are your cash flow needs, right? These are things. I mean, it's all about creating an effective plan that incorporates both personal needs and business needs.
Well, let me ask you this, because I think this is something that happens because a lot of people create these businesses and they're like, they don't necessarily know how to, like, what the valuation is. Like, it's like, how much is my business worth? A lot of people are their business, right? They're a technician and that, hey, I'm the business. So like, why would I worry about next phases? But every business is worth something, and every business kind of can be moved on. And I think from a community standpoint, it really is rough on a community when you have this business and they decide to retire and there's nothing to fill that void. So it's so much better to be like, hey, this is the place I always go to buy X, and they just retired, so I don't have anywhere now. And that leaves a hole in the community. But be able to pass that on is good for the community. Plus that helps, go from just being a startup. It has already a well-established business. So what are your exit strategies? Like, are they like, if you don't have an ear or an heir that you want to sell it to or give it to, like, what are your opportunities? What is like, what do you do?
So a business is much more valuable if you're ready to sell it before you plan to sell it. Okay. If the business functions without you being there to do the day-to-day, and you can just kind of turn the keys over to somebody, that's where the business valuation really explodes, right? And that's where people, then it would be feasible for a new owner to come in and take over and not miss a beat with cash flow, revenue, any of those types of things. And so you're exactly right, Eric. Where a lot of business owners spend their time working in the business and not on the business. So the most successful, business exit strategies that we've seen is where the business owner is really just checking metrics, right? They have the right management team in place and they're meeting with them, once a week and, hey, how are we doing, guys? And then they could turn the keys over to a potential buyer at any point.
Right. So a lot of times that comes down to, creating processes and procedures and having things in a systemized way of like, hey, this is how we operate this. This is products and probably having key influential like managers or operation leaders that can do a lot of that work. And once again, because that helps the business owner, because when you sell, if you close down, you don't get anything, right? But if you sell, there's a valuation that you could say, hey, this is how much it's worth. And then you get yourself a check. And that helps your retirement. That helps anything that you're planning to do, right? So how do you know how much money your business is worth? Is there a way to figure that out? Is there formulas?
There is. There are valuation experts that are available. But you're right. It's kind of, a lot of times a business owner, they feel that their business is worth X, and that could be nowhere close. It could be higher or lower. Just their buddy that works in the same industry sold their business for say $1 million last year, and they think, oh, mine's worth $1 million.
Right.
Well, that could be nowhere close.
Because it's not what you're making per year. That's not your valuation, because there's long-term, like, this is how much you can make over a course of time. It's not just like, oh, this is how much, my P&L said this year, right?
Exactly right. It's based on recurring cash flow. How much cash flow can the new owner expect to receive? And that's how they'll do evaluation on the business. But ultimately it comes down to, what does the business owner want? Do they want to sell it at some point?
Right.
Do they want to pass this over to their kids? These are all very personal discussions that, that business owners need to reflect on.
Right.
Because
who do they talk to? They talk to someone like yourself?
There's a team of people, and they would talk to someone like myself. They would obviously talk to their accountant. There are business exit strategists that we could pull in through some of our partners to help with this conversation.
I mean, do you think that when you start this, I mean, like, obviously I'm not at an age of retirement, but it would be nice to know how much my business is and what it's worth. And if something got to the point where like, hey, I want to, offload this and so forth, like, when do you start? Do you wait 5 years before you're going to retire? Do you do it a year before?
Yeah. I mean, these conversations should happen in advance. I mean, I would say a minimum of 5 years, especially if the business owner is the business. If they're working in the business, all the customers go to them. It takes time to build a team so that it runs without you being there. That's when the business is most valuable.
Yeah. Yeah. So, I mean, I think this is it's a realization point. Sometimes you have to look at it and say, as a business owner, all right, what is, this isn't just your baby anymore. This is an actual thing that helps fuels the economy. There's jobs, like, you have to think of a lot of this stuff. So just saying, hey, I'm done, everybody lock the door, everybody get new jobs, probably not the best thing for your employees, probably not the best thing for any, and then you're probably going to miss out on some type of payoff or anything to help your financial future, right? So if somebody is looking to learn more about this or do this, what's the first thing they should do?
They should talk to an advisor. They should talk to somebody about, hey, this is what I'm thinking. Does this make sense? Whether that's an attorney, whether that's their accountant, whether that's a wealth manager such as myself, but at least get the conversation started. And then it's also reflecting with your family.
Right.
If you're with your spouse, do you have kids that might be interested? If not, think about, what are the core values of your business, right? If you wanted to sell it, who would you want to sell it to? What's important to your employees? There's all kinds of, factors. What's important to your clients? But these are things that need to be well thought through before, the day comes whenever the business owner is no longer able to be there.
Yeah, no, I think that's great. And I think that's super helpful for everybody out there that's a small business owner, a business owner, or somebody that's projecting to want to be a business owner. But I think you gave some great tips today. The 5 tips basically can help you save money right now, make your business a lot better, along with those that are kind of looking to just know what their business is worth or even find some exit strategies. Any lasting comments or any suggestions that you would have for these business owners out here in the year 2026?
Take advantage of that 100% deduction that we have in the new tax bill. That's something that's great for businesses. If there's any capital expenditures that people have upcoming, this would be the year to do it, because there's some nice benefits, and it's a boost to the economy, because a lot of business owners are already taking advantage of it.
Yeah. And then, like you said earlier, there's a ton of small businesses. Kind of does fuel the economy in many aspects. Small businesses as the employees and is really stimulating a lot of the community. So I think that's going to do it here for today. Really appreciate everybody. I really appreciate your time. I think this is invaluable information for a lot of small businesses who don't necessarily have as much coaching or information. So having a podcast like this and you giving this information away is great. So thanks for tuning in. If today's topics got you thinking whether your business a little differently, whether it's taxes, structure, or even long-term exit plans, now's a good time to start those conversations. So Steve, how can people connect with you and learn more?
Yeah, we're at raymondjames.com/wheeling. You can also find me on LinkedIn.
Okay, thank you, Steve. All right, we'll be back soon with more strategies and real-world insights. Be sure to subscribe, follow along, and thanks to Steve and Riverbridge, your wealth building starts now.